Hello and welcome back to Dividend Destiny, the home of international income investing. Today we're going to talk about the spectre of inflation. Now, inflation is regarded by most everyday people as the general increase in the price of goods and services over a given period of time. This definition is partly true, but the underlying mechanisms for it are less well appreciated. Governments and central banks play a huge role in creating inflation by increasing the supply of currency beyond the rate of economic growth. This brings about an increase in prices, but in actuality, it is the erosion in purchasing power of the currency. Governments do this for a number of reasons. One is to pay off debt with devalued currency. Another is to fund programs and spending without increasing taxes. So inflation is a tax in and of itself, but it's a tax on the back end. If they were to put it on the front end, like income tax or any of the other taxes that are in your particular country, that would be politically unpalatable for the voting public. At the turn of the 20th century, the money supply in the United States and Great Britain was tied to gold reserves, the so-called gold standard. In 1971 and 1931, respectively, these links were severed. The money we use today is thus referred to as fiat currency. It is not backed by any particular commodity, and the supply of it can be manipulated by central banks at their discretion. Several thinkers have referred to inflation as a hidden tax, and I agree with this description. If a government opts to engage in military conflict, as is liable to happen from time to time and often under spurious motives, it's far easier to print the money, create it out of thin air, than levy huge tax increases on the populace. The pernicious effects of inflation manifested in this manner are not perceptible in the immediate term. Nevertheless, it's important to recognise that they do exist and will continue into the foreseeable future. The government creates inflation, which increases the prices of assets such as real estate and stocks. If said assets are sold and a capital gain is realised, the government taxes that as well. Therefore, we have the covert tax of inflation and overt tax on capital gains, both working in unison. It's a beautifully designed system, especially when you consider that the wage increases needed to maintain purchasing power often drag people into higher income tax thresholds. In an ideal world, the money supply would be increased commensurate with the productive output of the economy and not to excess. Instead, it's often businesses that bear the full brunt of the criticism for not increasing wages in line with inflation, when the public ire should be directed at central banks and government. To illustrate the effects of inflation, let's use an example. If the rate of inflation is 3% per year, a product or service that costs $100 in year 1 will cost $103 in year 2, $106.09 in year 3, $109.27 in year 4, and so on. If your wages only increase by 2% each year, your money will have lost 1% of its purchasing power on an annual basis. This degradation over time is perhaps best illustrated by looking at the value of the US dollar expressed in gold. Since 1947, the dollar has lost nearly all of its purchasing power. When applied to savings and investments, it is absolutely essential to consider the impact of inflation on the nominal return of your assets. At present, most savings accounts in the United Kingdom are still paying pitiful rates of interest, with only murmurings of increased rates on the horizon. And the situation is similar in the United States, with the Federal Reserve tentatively suggesting increases in the next year or two. Therefore, I only recommend that you use savings accounts for holding an emergency fund, a pot of money that can cover your expenses for 3 months minimum, or preferably 6 months. This should be a suitable backstop if you were to lose your job or face similar extenuating circumstances. You still want to earn as much interest as possible from a savings account to mitigate inflation to the best possible extent. But in relation to your investments, the calculation of your real rate of return by adjusting for inflation, taxes and fees is an essential component in evaluating the performance of your portfolio, and we will be releasing resources on this channel to enable you to do that in the coming weeks and months. You can think back to the credit crunch of 2007 to 2009, the real estate crash, the largest recession since the Great Depression in the 1930s. This event was my first real exposure to the financial markets, and I distinctly remember my employer at the time, their stock price declined very sharply. There was a palpable atmosphere of concerned malaise in the workplace, and with hindsight, it was a highly tumultuous time. If only I knew then what I do now, I could have deployed a decent amount of capital back then to buy attractively valued shares and be sitting on huge returns now. Funnily though, I wish I'd purchased the depressed stock of my employer, thus becoming an owner of my own productivity, essentially a salaried owner of my company but on a much smaller scale. In more recent years, the stock has traded at a 35% discount to its net asset value and has a yield of around 8%. But the business is still financially sound and produces modestly increasing cash flows on an annual basis. So it's interesting to look through personal history through the prism of financial awareness, and I urge you all to do the same. The nature of the financial crisis, its causes and implications, was completely lost on me back then. All I knew was that money would be tougher to come by in the housing market and in savings accounts, as interest rates were slashed to zero. Banks went from approving mortgages to anybody with a pulse at the height of the subprime lending era to wholesale tightening of the purse strings. This was after the government spent £500 billion of taxpayers' money bailing them out of their own mess, and savers would suffer dearly for nearly a decade as interest rates dropped to rock bottom. Central banks used quantitative easing, essentially money printing, to increase liquidity and stimulate the economy. Even now the returns on government bonds and savings accounts are pitiful. And most of these assets provide a negative return after you account for the impact of inflation and taxes. So in other words, the real rate of return is negative, and this is the disastrous outcome for your wealth. If you remember back in 2008, stock markets plummeted around the world, Standard & Poor's 500, S&P index losing 50% of its value in the 12-month period ending November 2008. However, the markets were not affected equally across the globe, with China and India experiencing growth during this period. And it was the first time in my life that I came to comprehend the forces that manipulate the economy and financial markets, the large private institutions and central banks like the Federal Reserve and Bank of England. I started to tune in to prominent investors and their commentary, people like Peter Schiff of Euro Pacific Capital, who successfully predicted the crisis back then and warned about it several years before it took place. And although the wheels began to turn, I wouldn't jump into the markets for a good while after that. But hopefully with that example, you can see the impact of inflation. And I think in the next few months, and certainly the next couple of years to come, we're going to see all of this money printing that's occurred during the worldwide pandemic is going to increase prices, not just of the things like lumber, oil, energy, natural resources, but also importantly food and the day-to-day provisions that we all depend on to run our lives. And you need to get your portfolios and assets engineered in the optimum way to benefit from that. Thanks again. You've been listening to Dividend Destiny.